This week, I collected $1,500 in premium selling out of the money puts on 3 stocks, Palantir, ALAB, and COHR. I did not just pick those stocks randomly. All 3 had one thing in common, pending earnings. And that's not a coincidence. Pre-earnings, the market is nervous. Nobody knows what the company is going to report. And that fear gets priced into the options as elevated implied volatility. And elevated IV means elevated theta, meaning those contracts are losing value faster than normal every single day. And as a put seller, that's exactly when you want to be entering, not after earnings. Before you sell the fear, you collect the premium, and then you wait for the resolve to take your profit. Before I walk you through the trades, let me give you the context, because the when matters just as much as the what. So the market this week had elevated implied volatility. And when I say that, here's what I mean in plain English. The market was nervous, fearful. There was uncertainty in the air. And that fear showed up as higher options premiums due to earnings. Think of it like insurance. When there is a hurricane warning, everyone rushes to buy insurance and the premiums spike. As an insurance company, which is basically what we are when we sell puts, that's exactly when you want to be selling. You collect more premium for the same risk. Okay, so I looked at the IV rank on my watch list this week and 3 names jumped out: Palantir, ALAB, and COHR. All 3 had elevated implied volatility, and they were in my would I own this stock zone, and both had clean setups for out of the money puts. Okay, right. That's the filter. Not what someone in Discord server said, right? Just IV rank, the right delta, and a stock I'd genuinely be happy to own at a discount. But first, let me explain the exact mechanic, because this is the whole edge. Before a company reports earnings, nobody knows what's coming. The market hates uncertainty, and that uncertainty gets priced into the option chain as elevated implied volatility. So IV spikes, and sometimes dramatically. So when IV is high, premiums are high, you're selling insurance during hurricane season. You collect more for the same risk. But here's what makes the pre-earning setups particularly powerful for put sellers. You don't need to be right about earnings result. You don't need to predict whether COHR beats or misses. You just need to sell before the event and let the event resolve. Even before the event, sometimes you could get good profits. Because here's what happens after earnings come. Almost every single time, regardless of whether the number was good or bad, implied volatility collapses. And that's called IV crash. And the uncertainty is gone. The market reprices the options immediately. And the put you sold, its value drops fast. Not just from PETA, but from IV deflating on top of it, right? You get 2 forces working for you simultaneously. 1, theta decay, time is passing, the option is worth less every day. 2, IV crash, the uncertainty premium evaporates the moment earnings hit. That double decay is why both trades hit my 30% target before the expiration date, June 18th. And I was out in 2 days. And this is the part most options traders don't talk about. They show you the trade, they show you the profit, but they don't explain why it worked faster than normal. And this is why you're not predicting the earnings. You're selling the market's fear of the unknown. And when unknown resolves, you collect. Okay. The first trade I made with Palantir. Palantir is a stock that I know well. I've been trading it for 3 or 4 years. Large cap fundamentals support my criteria of a stock I would own. And this week with the volatility pop, implied volatility was elevated. Exactly what I want to see before I sell a single option. And what I did, Wednesday, April 29th, I sold 2 out of the money put contracts at a strike of $120 with an expiration of June 18th. And at the time of entry, Palantir was trading around 135, so my strike was sitting comfortably below the market. The delta was around 0.2, firmly in my 20 to 30 range, and I collected a premium of $467 per contract, total of $934. I also had a $135 strike expiring in May 15, right after the earnings. Here's the first question I always ask myself before I place a trade. If Palantir drops hard and I get a sign, if I'm forced to buy 100 shares at my strike price, am I okay with that? And yes, Palantir is a company I believe in the long term. I'd own it at a discount, and that answer has to be yes before I enter. That's not negotiable. So the trade went on June 18 expiration. That's about 45 days out from entry. And I was not planning to sit and wait until June 18. That's not my system. I'll explain the exit in a minute. And the second one is ALAB, Astrolabs, and it caught my eye this week for the same reason as Palantir. Implied volatility was elevated and it passed all 5 of my screener filters. The setup was clean. I sold 2 out of the money puts contracts at a strike of $160, expiring June 18. And it was trading around 195 at entry. Right now it's in a bullish trend. So Delta was around 2. Premium collected was $930 per share. And it has a huge IV. And would I be happy owning ALAB at the same price if I get a sign? Yes. In fact, I have right now 200 shares of ALAB, which I sold covered calls on and probably get called away on May 15 at $150 and $190 levels. That's why I kind of made the list, because I also put one put at $170 strike, May 15 expiration, collected like $590 in premiums. And the third trade with Coherent was also very important because it also had a specific catalyst driving the volatility next week, which is earnings. That's exactly why it made my list. When a stock has a pending earnings event, implied volatility spikes, and sometimes dramatically. An IV rank on Coherent this week was elevated well above its historical norm. That means the premium I could collect for the same delta put was meaningfully higher than it would be on a normal week. Okay, I sold 1 out of the money put contracts at a strike of $230 because it had a good support level on that level, expiring June 18, and Coherent was trading around $305 at entry. My strike was $70 out of the money, and I collected $1,230 in premium. So one thing I want to be transparent about the earnings. I entered Coherent before the earnings came out when the volatility is super high. That means at the time of entry, I was holding a position through a binary event. If Coherent dropped 25% on a bad stop, my strike could have been tested. So I did 2 things differently with this trade versus a non-earning setup. First, I sized smaller, fewer contracts than my standard position, higher premium per contract, but less total capital at risk. Second, I made sure my answer to the would I own it question was a hard yes. Before earnings, not after. Because if the worst case happened and I got a sign, I needed to be genuinely comfortable holding Coherent shares at my strike price while it recovered. And I'm okay with that because I believe in the company. This is a calculated decision, and the calculation has to happen before you enter, not after the stock moves against you. But here's what actually happened. Even before the earnings out, stock moved up. The option I sold dropped in value fast, and within 2 days, I was at 40% profit in premiums. I just bought it back and done. That's the pre-earnings put selling system. For the exit, here's where a lot of new options traders make a mistake. They open a trade with a June expiration and think, okay, I'll just wait until June 18, collect the full premium and move on. And I get it. That sounds logical. Maximum profit, wait for expiration rate. But here's the reality. When you sell a put with 30 to 45 days until expiration, the bulk of your theta decay, the time value erosion, that is your profit. It happens in the first half of that window. If I earn 30% of premium less than the 30% of the time of the expiration, I exit the trade. And with earnings-driven IV like I had this week on Coherent, Palantir, and ALAB, that 30% target can hit faster than you expect. Because it's not just theta doing the work. It's IV crash on top of theta. Double decay. When the earnings come out and the uncertainty resolves, the implied volatility in that option deflates quickly, and your buyback price drops faster. And that's not magic. That's the mechanics I'm going after. And once you understand it, you're going to start seeing why elevated IV environments aren't scary. They're efficient. And specifically for earnings setups, I look for stocks reporting within the 2 to 4 weeks. And that's my sweet spot. Far enough out that the option still has meaningful premium, close enough that the earnings catalyst will resolve well before the expiration, giving me the IV crash window I need to exit early. Palantir, ALAB, and COHR all fit that window this week, and all three had pre-earnings IV elevated well above their historical norm, and all three are the stocks I would want to own due to their moat and good fundamentals. And that's the screener telling me the market is nervous about this one. Go collect it. Go collect that nervousness as premium. And one more thing, if you're new to earnings setups, start with one contract on a stock you know well. Let the mechanics play out once in real time before you scale. Watching IV crash your position's value in your favor is the best education you'll ever get, right? I did not predict the earnings result. I did not need to. I solved the fear of the unknown, waited for the earnings to resolve, and let the IV crash do the heavy lifting on top of the data decay. Both forces working for me at the same time. Within days, not weeks, I didn't even have to wait for the earnings, with the price moving a little up. With the theta decay so high and IV so high, all three positions hit my 30% profit target. I bought them back, closed, capital freed, no day trading, no screen watching, no gambling on direction. That's the pre-earnings put selling system. It's conservative, it's repeatable, and you can be consistent with that. And it's designed to let you sleep at night. So if you like this breakdown, hit that subscribe button, ring the notification bell so you never miss a video, and drop a comment below.